Can an economy truly withstand complete isolation from the global financial system and free trade? That's the critical question facing Russia as it endures an escalating sanctions campaign by Western nations over the invasion of Ukraine. Sanctions have crippled Russia's ties with Europe and North America, while draining its foreign reserves and denying access to vital technologies. Yet against all odds, Russia's GDP is actually projected to grow in 2024, outpacing estimates for the US, UK, and European Union. How has Moscow managed to defy dire predictions of collapse? The answer lies in a unique combination of smart policies, economic distortions, and luck. When Russia invaded Ukraine in February 2022, Western nations swiftly enacted the most brutal economic sanctions ever imposed on a major economy in retaliation. These measures have undoubtedly taken a significant toll on Russia. We can't deny that the sanctions have severely disrupted Russian trade flows, sparked a mass exodus of foreign businesses and investment capital, frozen around $600 billion of the Russian central bank's assets held abroad, and blocked Russia's access to vital technologies, inputs, and global financial systems like SWIFT. The damage from this economic warfare has been substantial and wide-ranging. Russia's GDP dropped by around 2.1% in 2022, according to official statistics from the Kremlin, but many independent analysts believe the real contraction was likely deeper. Imports plunged by nearly 30% year-over-year, starving domestic industries of vital components, materials, and consumer goods. Hundreds of major Western companies, from McDonald's and IKEA to Boeing and ExxonMobil, suspended their operations in Russia, delivering further shocks to the economy. Severe restrictions on exports of semiconductors, airport parts, computers, telecoms equipment, and other high-tech goods from the US, EU, and allies crippled Russia's access to technologies critical for both military and civilian industries. The effects radiated across nearly every sector of the economy. Russian airlines were forced to ground planes and cancel international routes as they couldn't source parts or service their foreign-built aircraft. Automotive production completely stalled due to shortages of imported components. Major infrastructure and energy projects faced delays and disruptions due to the lack of foreign equipment and services. The tech sector came to a halt with an exodus of skilled labor and cutoffs from vital semiconductors, software, and computing hardware. Let's not mince words, these coordinated sanctions delivered a substantial economic blow that reverberated throughout Russia's economy and financial markets. Even the Russian central bank admitted the harsh measures were a material game-changer that triggered turmoil and volatility across all asset classes. We saw the ruble plummet in value by around 40% against the US dollar in the weeks after the invasion. Inflation spiked into the double digits as import costs soared. The Kremlin was forced into urgent crisis economic policies, spending billions in foreign currency reserves to prop up the ruble's plunging value, more than doubling the interest rates, instituting strict capital controls, and closing the Moscow Stock Exchange for over a month. Western analysts warned that the combination of sanctions, capital flight, and loss of access to financial markets could cause even deeper long-term damage, with projections of Russia's GDP shrinking by 10 to 15% or more over the coming years. While Russia managed to partially stabilize the economic shockwaves in the following months, the severe impacts of Western sanctions were utterly undeniable in those first few months of the conflict. The measures hit Russia's economy like a sledgehammer, delivering substantial and broad-based disruption. Only the Kremlin's policy interventions and remaining economic buffers prevented a full-blown financial crisis and economic meltdown in the opening stages of the war. However, as we look objectively at the data over the past year, it's clear that Russia's economy has proven more resilient and adapted than many anticipated. Despite the intense pressures of sanctions, economic isolation, and wartime spending burdens, the latest IMF forecasts show Russia's GDP growing by 0.7% in 2023 and an impressive 3.2% in 2024, outpacing growth projections for most advanced economies. So, how has Russia managed this surprising turnaround? We have to give credit where it's due. Smart policy decisions combined with a few key economic lifelines enabled Russia to stabilize its situation faster than expected. First, the Kremlin acted swiftly to shore up the financial system, imposing strict capital controls and raising interest rates to stem the ruble's freefall and flight of money. While controversial and economically damaging in the short term, these moves helped prevent a full-blown financial meltdown and economic collapse. Next, Russia rapidly pivoted its export flows, redirecting oil, gas, and other commodities to still willing buyers in Asia, especially India and China. High global energy prices also boosted revenues from Russia's energy exports in 2022, temporarily offsetting the impacts of Western embargoes. Additionally, Russia took steps to replace Western imports with domestic production through its long-standing import substitution policies. We can't ignore that Russia's economic model has fundamentally shifted to cope with sanctions and diminish ties to Europe and North America. The self-imposed isolation and push for greater self-sufficiency has transformed Russia into what some economists call a closed-cycle economy, centered around state corporations, import substitutions, and ramped-up domestic production. This decoupling from the West has deepened economic dependence on China as both a trade partner and source of investment and technology transfers. Even before 2022, Western sanctions had encouraged Russia to deepen its embrace of China. In 2023, trade turnover between the two countries exceeded $240 billion, with China accounting for 38% of Russian imports and 31% of Russian exports. Chinese firms like Huawei, Xiaomi, and Great Wall Motors have filled the vacuum left by Western companies exiting Russia. China is also a vital energy importer for Moscow. Beijing now takes nearly 20% of Russia's oil exports and has increased imports of discounted Russian crude. The two nations have doubled down on de-dollarization efforts, rapidly increasing their use of their national currencies for bilateral trade settlements and exploring new cross-border payment systems. However, this reorientation towards China and other non-Western partners comes with risks of over-reliance and exploitation. Beijing enjoys leverage as the dominant trade partner, permitting it to demand discounts for Russian oil and gas while flooding the Russian market with exports. Some analysts warn of Russia becoming a raw materials appendage to feed China's economic rise. At the core of Russia's economic challenges and resilience lies its long-standing dependency on energy exports, particularly oil and natural gas. This resilience is a double-edged sword. High global energy prices provide a crucial economic buffer, but also entrench Russia's commodity-based economic model that Western sanctions aim to disrupt. While Europe has dramatically reduced imports of pipeline gas, Russia has successfully redirected those flows to other markets, especially Turkey and China. However, there are signs that the sanctions noose is slowly tightening around Russia's energy sector. The G7's price cap on Russian oil exports appears to be gradually eroding Moscow's revenues. More customers like India have begun bargaining harder for steeper Russian oil discounts. New EU bans on Russian oil products are expected to significantly constrict that key export revenue stream. Looking ahead, the more impactful EU embargoes on pipeline gas imports from Russia truly take effect in 2025. As Europe successfully pivots away from Russian energy dependence over the next couple of years, Moscow will be pressed to find new major gas importers or accept reduced production and revenues. This could prove economically devastating in the long run if alternatives don't emerge. Russia remains heavily exposed to fluctuations in global energy markets. Its economy has benefited greatly from the elevated oil and gas prices in 2022, fueled by tight post-pandemic supply and market disruptions tied to the Ukraine war. However, if prices reverse on slowing global demand or increased supply from other producers, Russia's main revenue engine will sputter. The risks surrounding this vulnerability were highlighted when oil briefly dipped under $70 per barrel in late 2022. Turning to fiscal policy, Russia's massive wartime spending has strained government budgets and forced some unpopular measures, even as the energy export windfall temporarily eased deficits. According to official data, Russia's defense spending soared to $84 billion in 2023, 40% more than initial military budget announced in 2021, with further increases expected in 2024 and likely beyond. This military Keynesianism, combined with social support measures like raising pensions and public sector salaries, caused budget outlays to balloon. During 2022 and 2023, Russia instituted a crisis budget, funded primarily through drawing down over $50 billion from its rainy day national wealth fund reserves. To balance budgets going forward, deeply unpopular steps like raising taxes on businesses and citizens are under consideration. The increased economic burdens coincided with a sharp contraction in real disposable household incomes and elevated inflation that eroded purchasing power for ordinary Russians. In 2022, real disposable incomes sank drastically, while consumer inflation hit 16% at its peak last summer. This squeeze on living standards remains the biggest social pressure point that could spark wider discontent if cost of living pressures fail to moderate soon. The Kremlin clearly understands the importance of maintaining domestic economic and social stability. The painful lessons of the 1990s chaos are still potent. State spending on everything from the military to social support payments must be carefully calibrated to prevent a broader meltdown that could jeopardize Putin's hold on power. However, the longer the war drags on and the economic distortions mount, this policy tightrope will only become more difficult to navigate. Beyond the direct impacts of trade restrictions and financial blockades, arguably the most significant long-term threat to Russia's economic development stems from Western technology sanctions and human capital flight. Over 4.8 million skilled professionals, including engineers, scientists, and IT workers, have left Russia in just 2023. This brain drain compounds Russia's deepening technological isolation from vital semiconductor supplies, industrial equipment, software, and expertise. The combination severely constrains Russia's ability to develop modern, globally competitive industries beyond extraction and commodity processing. Russia has ambitious plans to develop its own domestic microelectronics industry and achieve technological sovereignty. However, most analysts are deeply skeptical Moscow can truly insulate itself from foreign dependencies on semiconductors, computing hardware, software, and other vital tech inputs anytime soon. Even Russia's flagship Baikal line of processors designed for military and industrial applications heavily relied on foreign chip design tools and manufacturing equipment, now restricted under sanctions. Plans to develop a full domestic chip manufacturing ecosystem from design to fabrication face immense technical hurdles and likely remain a decade or more away under the best-case scenarios. Without restoring access to foreign technologies and reversing brain drain trends, Russia risks becoming trapped in a vicious cycle. Its industries steadily lose competitiveness and innovative capacity, making it ever more reliant on extracting and exporting raw commodities, a path of steadily diminishing economic returns. While Russia's economy hasn't imploded as some predicted, the impacts of sanctions have created worrying economic distortions and imbalances. Excessive state control, inefficient resource allocation, rent-seeking behavior, and lack of competition now pervade, echoing problems that plagued the late Soviet system. Russia's much-praised import substitution drive has made some progress replacing Western goods with domestic alternatives. However, quality issues are there, and the process is extremely inefficient. Relying on heavy state subsidies, protectionism, and price controls, Russia can ill afford the erosion of productivity and innovation accompanying this lurch back towards a command economy approach. Moreover, Russia is increasingly monopolizing and centralizing control over strategic economic assets and industries. The state has directly nationalized or co-opted private companies in sectors like aviation, autos, tech, and energy deemed critical for the war effort or to counter Western sanctions. A handful of state corporations and crony capitalist entities close to Putin are amassing outsized economic clout. There are also worrying signs of rising corruption and capital flight as Russia's private sector is increasingly cannibalized to fund the war machine. An estimated $120 billion or more in capital has fled Russia since February 2022, with wealthy oligarchs and businesses shifting assets abroad to shelter their wealth. While some level of fortress economic measures was perhaps inevitable given the intensity of Western sanctions, their excess and lack of reform momentum raise serious questions about Russia's future development path. Without urgent course corrections, Russia risks cementing itself as an inefficient petrostate mired in stagnation. So, where does this leave the Russian economy looking ahead? Realistically, the outlook appears quite cloudy with both upside possibilities and severe downside risks. On the upside, if Russia manages to find new major energy importers, develop successful import substitution capabilities, and avoids more punitive sanctions, it could theoretically maintain reasonable GDP growth of 2 to 3% annually. An extended period of high global oil and gas prices would provide an economic windfall to fund Putin's military adventures. However, more plausible base case projections see Russia's economy stagnating or contracting in the coming years as trade barriers solidify, technology gaps widen, import dependency persists, the skilled labor force dwindles, and the Kremlin prioritizes military spending over productivity-enhancing investments. Moreover, if Western sanctions completely sever Russia from residual oil, gas, and commodities revenue streams, the downside scenario could resemble a full-blown economic meltdown and potential depression. Russia's status as a BRICS partner would be the only thing preventing a return to 1990s level chaos. We must remember that Russia's economic stability remained heavily contingent on revenues from exporting depleting natural resources like oil and gas. As trade barriers rise and technology dependence persists, Russia will find it extremely challenging to meaningfully diversify and transition to a productive, modern economy. Love it or hate it, you have to admit Russia has displayed impressive resilience and policy dexterity so far to avoid a complete meltdown. However, the data clearly shows the long-term outlook remains fraught with daunting challenges and systemic risks that could unravel the tenuous stabilization. Only time will tell if Moscow has the wherewithal to break its dependence on depleting natural resources and authoritarian economic distortions. The conflict has laid bare both the limitations and enduring strengths of Russia's economic fortitude. We'll keep monitoring all the latest developments, so make sure to drop your analysis in the comments below. Hit that like button if you found value in this video, subscribe to our channel for more hard-hitting economic and geopolitical insights, and ring that notification bell so you don't miss our future uploads. Thanks for watching. We'll see you next time.